Now I'm introducing Carlo. Carlo Altavilla is the head of the Monetary Analysis Division at the European Central Bank, and he chairs the Monetary Policy Committee's task force on banking analysis. Before joining the ECB, he taught economic policy and econometrics at the University of Naples and served as a visiting professor and scholar at the University College London, Columbia University, and the Université Libre de Bruxelles. In his current position, he oversees the assessment of liquidity and funding conditions for banks and non-banks in the euro area, analyzes macro-financial linkages, and the calibration of both standard and non-standard monetary measures involving financial intermediaries. He is a research fellow at both the CPR and CESIFO, and he has published extensively in leading academic journals, and he co-authored the book Monetary Policy in Time of Crisis with Oxford University Press. So let me introduce Carlo for his talk.
Okay, so thanks a lot for inviting me, and it's a great pleasure to be here. That's my first time in Malta, and actually I'm really impressed by, well, first the beauty of the country, the city, and also the quality of the research that you have been presenting. So I'm really glad to be here with you today. So that's what I will present is an ongoing work with two colleagues from the ECB, Massimo Rostagno and Julian Schumacher. And probably the most important things I will say is these little red things in the slide, that whatever I say is just me or us and not the ECB or any central bank of the Euro system. That's an ongoing work on, and it's the first time I'm presenting with this title, by the way, so comments, of course, are more than welcome. And feel free to interrupt me whenever you want, or just raise your hand. It's a work on banks' reluctance to intermediate. Already the title might seem controversial if you think of the last 40 years of economic literature saying that normally banks tend to overextend. Right? There is a huge literature starting from Gertler, Kiyotaki, Moore, many very important papers that we have been raised with as economists, especially if you work in a central bank or if you study financial economics or banking. You are raised with the idea that banks tend to overextend, and they tend to fuel financial crises because of that. So this is all true, and you will see we'll have a part where we'll corroborate this idea. But at the same time, what we try to understand in this paper is the possibility that there is an under-provisioning bias. So banks under-provision under certain circumstances because they are simply not able to internalize the welfare objective of extending more lending to the private sector, and so that they can invest at the level that is expected and maximizing the economy. So I'll be more clear in a while by what I mean. So let me go ahead with the research question that we have. Again, I repeat, there is an influential, and it's important, stand of literature that would say that by extending more loans that would otherwise need to be in the economy, banks tend to fuel financial crisis. This has spurred, if you want, reforms of regulatory reforms that have been through in our system via Basel, via higher, stricter regulation. So this is a lot of good, if you want, effect. But at the same time, when we look at the market commentaries or policymaker statement, they always tend to say, and you will see this always means across jurisdiction and times, since the 1920s at least, they always say that banks tend to borrow reluctantly from central banks. So on one side, they don't want to, they lend a lot. On the other side, when they come to a central banks, banks are reluctant to come. And when they come in a standard refinancing operation, they're not in a position to lend on the borrowed reserves. And so the question is here whether first there is a nexus between the central bank borrowing and lending. So what type of nexus is here? And the second question I'll be dealing with is whether any source of liquidity is similar, or whether the source of liquidity through which banks acquire liquidity from the system, meaning standard refinancing operation, credit easing operation, think of a TLTRO, targeting long-term refinancing operation, or QE, these are all equally affecting banks' behavior in terms of how they will be able to extend loans. There is a theory part in the paper, which I'll not go through, so I'll mostly concentrate on the empirics. But I'll give you at least a sense of what we find in the model. So the model is a simple model, but what we model is an economy where, because of the bank's failure to internalize the social objective to extend loans, and by this extension to produce an investment or stimulate investment in the firms, you have mainly three results. The first result is that in a lender of last resort regime, so meaning when imagine you have a negative shock and the bank goes to the central bank only for borrowing money, and so after giving, of course, eligible collateral. So the banks are really reluctant to do that. So they come to the central bank, they go to the central bank, they borrow the money, but as soon as they borrow the money, the only things they want really to do is to give back this money to the central bank. So they don't want to lend on the borrowed reserves. The second is that when instead the central bank introduce a credit easing policy, so credit easings are, again, think of TLTROs in the reality, and in the empirical part, the credit easing you will see will be, in effect, targeting long-term refinancing operation. This credit easing position the economy, or the equilibrium of the economy, closer to the social optimum, especially in absence of production externality. When there are these externalities, the only way you can reach the social maximum is by introducing QE. So that's more or less the three results of the theoretical model. Again, I will not go through the equation and all the formulation of the model. I will try instead to understand whether in the data these kind of results that we get from the model are verified. So the idea would be to use a lot of data, different modeling technique, ranging from, again, Bayesian VR to panel data with loan-by-loan data, and to understand whether we do see these dynamics playing in the euro area. So, of course, the laboratory would be only euro area country, all euro area country, sometimes aggregate, sometimes, again, granularly aggregated by looking at the firm-bank relationship. Okay, so in the empirics instead, what we'll find, let me give you a preview of what you will see now in the next half an hour. So first, we do find that there is a lack of connection between the reserve borrowed at the central bank in a standard refinancing operation and loans extended by bank to firms. And this for us is, again, as a support, corroborates the idea of this reluctancy hypothesis. Second, we do find that when you introduce credit easing and quantitative easing, banks now, you change, in effect, what you do as a central bank, you change the nature of the liquidity, and you introduce this liquidity that is now more persistent in the system. Banks rely more on this liquidity and then extend loans because of that. And in the data, this will be, again, non-borrowed reserves, meaning think of QE, quantitative easing, or credit easing reserves, meaning in the data territories. And the third part, we look into whether this is then have any real economic effect. So whether by extending loans to firms, once they borrow under the credit easing or by a QE, now there is a positive impact on investment in the economy. That's a literature. There's a huge literature, as I was saying. Probably I'll be very brief on that, starting from the reluctance to borrow in the central bank funds. Most of the paper that looks at this reluctance, actually in the past, we're not the first to say that, have mostly explained this reluctance by a stigma effect. So the idea is that potentially when a commercial bank comes to a standard facility of a central bank, market would know, other peers would know. They understand that potentially this bank is going to a central bank instead of going to the market because of issues, and it gets stigmatized. So because of stigma, the banks because of this potential stigma being in place, the banks actually first doesn't want to even go to the central bank. Second, when it goes, it really wants to get rid of these borrowed reserves as soon as possible. So in this sense, it will not lend on these reserves again. There's again a very new literature on central bank reserve bank lending. You see many papers here. Most of the paper actually established a positive connection between central bank reserves and bank lending. There's only one paper that is actually find the opposite. It's the penultimate papers here on the list. But again, the vast majority of the literature, of this very new literature, finds that central bank reserves are positively correlated to bank lending. Now, again, our model produce these 4 testable hypotheses, and I'll go now mostly in the last 3. But the 4 hypotheses coming from the model that we want to verify in the data are: first, banks are generally reluctant to borrow. Second, if the standard refinancing operation is the only facility available to banks, when there is an adverse shock hitting the economy, what bank would do is to borrow into this facility, but even contract lending. So they would not lend on the borrowed reserves. Second, credit easing and credit easing and quantitative easing, by changing the nature of the liquidity, would encourage banks to lend. And the last point, again, that the credit obtained via this facility then would be productive, meaning would increase investment and income. So would have some real effect. So let me start with the outline. That's the outline of the presentation. I will now first briefly go into a few stylized facts, then I'll go into these 4 testable hypotheses with the data, and then I'll conclude. So let me briefly say as well, I guess most of you are familiar with these 2 graphs. This is how we now think of monetary policy conditions in the euro area. You will see that until 2007, basically the euro system was conducting monetary policy essentially by changing interest rate. You see on the right-hand side, and the right-hand side chart is the excess liquidity, namely the sum of current account and deposit facility minus minimum reserve requirement. Before 2007 was 0, meaning that we were in a regime of neutral liquidity allotment. But then after the great financial crisis, you see that there's been a movement also on the right-hand side with successive liquidity measures introduced, first in the form of unconstrained liquidity, and then you see constrained liquidity, so TLTRO, 3 recalibration of TLTRO, I'll be more precise in a while, and then the ramping up of excess liquidity is mostly due, again, to the TLTRO 3, and then to the APP and PEP, so the two measures of quantitative easing of large-scale asset purchases that we have seen in the Eurosystem. While on the right-hand side, you see that there was basically a decline into the negative territory. This was also a specificity of Euro area that in other jurisdictions was not seen. You might have noticed that, for example, US, where it's never pushed the rates into the negative territory, and now the last, you see first the tightening cycle, and now we are at the 3.25 with the deposit rate that meanwhile has become the main policy rate to measure the stance, as you have seen probably in the last monetary policy statement. So that's the condition. Now we want to, this is the liquidity, so we'll mostly look at the right-hand side chart of the of these monetary policy conditions, if you want. But excess liquidity is not enough for us because we want to break down this excess liquidity into parts, and we want to understand which part is due to standard refinancing operation, the part that is due to instead credit easing, and the part that is due to non-borrowed reserves or quantitative easing. Why non-borrowed? Because actually the bank would not borrow directly for obtaining this liquidity, but via QE, they would end up exactly in the bank balance sheet, this liquidity. So again, the difference will be between borrowed, credit easing, and non-borrowed reserves. Now, again, just so that we're all on the same page, quantitative easing in the Euro area, we had two major programs. The first started in January 15, or actually in September 14, but let's say January 15. That's the APP, the first row. You see the, the flows and the accumulated stock outstanding, with now starting to decline because of the quantitative tightening in place. And the second one is the second row, you get the pandemic purchase program, the PEP. So this would be the amount of non-borrowed reserves in the system. And that would be instead also borrowed reserves and credit easing reserves. And this instead you can find it on the left-hand side. So the left-hand side shows you the evolution of Eurosystem borrowing through the various liquidity facilities since the start of the Euro area. And you see that at the start, the green area is the one dominating, meaning the MRO, so the standard refinancing operation. Lending into the MRO or in the unconstrained liquidity would be what I call borrowed reserves. So a bank has to actually go to the central bank and ask for liquidity in a weekly operation that's in the MRO. What I would call instead credit easing reserves is the blue and yellow and red area on the left-hand side, that are the 3 rounds of recalibration of the targeted long-term refinancing operation. This liquidity is very different from the unconstrained one. First, because you have a long-term ahead of you to repay the central bank. Normally, the operation had 3 years of maturity. So when you borrow liquidity under TLTRO, you as a bank know that you have to repay if you want. You can repay early, but if you want to repay at the maturity is 3 years. You have a longer time ahead of you to then program and plan in case you want to lend the acquired funds. And second, the other major difference that the T in front of the TLTRO means that it was targeted, so meaning that the banks had a target in terms of lending to obtain the better price of the liquidity they have borrowed. And this price, you might have, you might remember probably that during the pandemic reached -1%. So -1% means that actually the ECB was offering more money that it would otherwise banks would borrow. And was the minimum, actually, interest rate in the system, because we, of course, the DFR was, the minimum DFR was at 0.5, minus 0.5. Okay, and in fact, when we moved to the minus 1%, you see the blue area skyrocketing to 2.2 trillion euro. This is the June 20 operation, with that then 3 years of maturity. And then you see now, basically, in December this year, there will be the maturity of the last TLTRO operation, so we will not have maturing TLTRO anymore in the system. Okay, this is more or less and this would be what I call credit easing reserves. Okay, so borrowed reserves are basically MRO or LTRO, unconstrained. Credit easing reserves are TLTRO, and non-borrowed reserves are QE funds that banks get in their balance sheet because of the open market operations. Okay, so first, now let me go into the empirical questions. So the first question, again, banks are reluctant to borrow. Here, I will not, in the paper there is analysis, I will not go into the analysis, I just want to stress that since the 1920s, economists at the Fed have actually pointed out that banks would not want to come to a central bank to borrow money. And this has been going on, these observations, in various papers and analysis, market commentaries, in various market conditions, regulatory environment, jurisdiction. I pointed here only papers from Great Depression, analyzing the 80s, Great Financial Crisis, or even more recently, 13, 14. So there is a bulk of evidence in the literature that this is happening, so that there is a reluctance of banks to access the discount window for the Fed or the regular standard refinancing operation for the ECB. Now, how this reflects into then the economics of the bank lending liquidity relationship. So the first things we want to corroborate is the idea that when the bank when the economy is hit by a negative shock, and this negative shock in the data would be a temporary drop of 1% in the industrial production, so a contractionary shock, negative shock from the economy, the real side of the economy. We want to understand how banks react to this. So the easier thing you might imagine is to build up a Bayesian VR with a few variables. That's on the left-hand side. You see more or less the variable. We have the model that we use and the variable that enter in the VR. These are industrial production, borrowed reserve, interest rate, inflation, the usual suspect you might imagine that are present in the macro model that won't explain macro financial linkages. And now we want to understand what happened again following in a decrease in industrial production. So industrial production is the variable that we shock, and then we observe the endogenous reaction of the other variable. And on the right-hand side, you see the response of the variable. So first, an adverse shock would be banks tend to react by increasing their borrowed reserves. So in fact, they would go in the model, they would go to the central bank and ask for money in exchange of course, eligible collateral. But this shock would not be, but the reserves or this liquidity would not be coupled then with the more loans. Actually, it's the opposite. As the model, as the theoretical model would suggest, the data corroborates that loans to firms in the data goes down when borrowed reserves goes up because of an adverse shocks to the economy. Now, you might think that this is a very aggregate, probably each bank is different. So what we did is to go from the aggregate euro area level now to one step down into the granularity environment. And you will see that we'll go down various layers of granularity. But the first is moving from this aggregate euro area, if you want, correlations with the VR, to something that resemble more a real world experiment, where we now shock each bank. So we have 350 banks, and we have this is in a sample of a confidential data set called the IPSI, individual balance sheet item of the banks in the euro area, where we basically can monitor the behavior of the measured 350 euro banks, covering about 80% of the outstanding amount of loans. So we move from this model that is a BVAR to a panel BVAR. And just in the formulation, you see that the model introduced now these I and J, meaning that now I'm able to understand what happens to a loan extended by a bank I operating in a country J at time T. And you do the same, but in a panel setting. So at this point, you can monitor the bank-by-bank reply on the lending, following an adverse shock to industrial production. And you see on the right-hand side that the result is pretty much similar. So the bulk of the distribution of the bank would react by reducing loans, following a shock that is at the same time reducing the industrial production, but also increasing the borrowed reserves. So we find this again as corroborating the second hypothesis of the model. Now we go in the third hypothesis of the model that instead is probably the core of the paper that looks at the bank lending and various regime of liquidity provision. Here we will start at the bank level, and then I'll go another layer down in the granularity by looking at the individual loan relationship. So most of the result I will show you resemble pretty much this chart. And this chart would say that if you have a local projection model, and the model is the one that you see on top of this slide, and you put on the left-hand side the lending of a bank I at time t plus h, and you try to now understand how these loans evolve following shocks into reserves and to these various reserves. And you want to understand this reserve being non-borrowed, borrowed, or credit-easing reserves, more or less you always have this result that are shown in this chart. So borrowed reserves and credit-easing reserves would actually increase lending, while borrowed reserves would not have any effect, any impact on lending. So it means that following an increase in non-borrowed reserves, meaning QE, banks tend to extend more credit to the economy. Following, this is the left-hand side chart, following a shock that increase TLTRO, or increase credit easing reserves, this is the right-hand side the chart, banks tend to increase lending. This doesn't happen when instead you have an increase in borrowed reserves. And also this, if you want, is pretty much, again, is a corroboration of the idea of the model that when banks comes in the standard refinancing operation, they are not then planning on extending loans on the borrowed liquidity, while this is not the case for credit easing and QE reserves. Now, of course, what I showed you here is just a model that has two potential issues. The first is that liquidity sometimes is an endogenous variable. So when you are a bank, you ask for liquidity. So the variable, the treatment can be actually endogenous to the outcome variable, and you want to control for that. So meaning that there might be a bias between the observation of lending between a bank that asks for liquidity and a bank that don't ask for liquidity, and we want to control for this. And the second is that there is normally a presumption that this bank level data is not able to fully capture or fully control for demand condition in the economy. So the first issue will pose a remedy by introducing an instrumental variable approach. The second issue will instead, to remedy to this second issue, will instead use credit registry data from Anacredit. I'll be clear in a moment. Okay, so first issue. And the question really is, does not random selection of bank, because banks ask liquidity, so they want to be treated, if you want, introduce a bias in our empirical analysis? Probably yes. To pose a remedy to this, we use a very old idea of this Bartik-like shift share instrument, where you basically control for the shift in the instrument and the share of each bank has in the borrowed and non-borrowed reserves. And when you apply this to a local projection environment, though at this moment you have a local projection instrumental variable approach, and you redo the analysis that I showed you before in the chart, you get this plot. Again, these are the response of bank loans after a 1 percentage point increase in the central bank reserves of various type. And this various type, again, non-borrowed reserves and TLTRO would increase lending. Recourse to borrowed reserves instead would not generate any effect on lending. So it means that, again, if you try to control for the endogeneity of banks demanding liquidity, more or less you will get the same result. Second issue is, well, there is a lot of robustness. Second issue, as I was saying, is that you probably cannot control fully for the demand condition. And to do that, we, again, use instead the same setting, the same sort of model or parameters of the model, but now we go, again, one layer down in the granularity assessment, and we use Anacredit. This is, you might know, this is an harmonized credit registry at the euro area level, so it combines at loan level all relationship between banks and firms that are registered into this data set that are above 25,000 euro. So whatever is above 25,000 is in the data set. At that point, you can collapse the data set at bank loan, at bank firm level. What we do is to match then Anacredit with the characteristics of the firms and characteristics of the banks. So we have a data set that has more or less 60 million observation with the banks, with all the banks operating in the euro area, characteristics of the banks, and all the firms with which they have a relationship within Anacredit, and characteristics of the firms. So we basically control, if you want, more or less most of the endogeneity that you might think would come from not being able to assess the demand conditions. So these are the main variable that we look at. And when we assess whether we are able to get the same result, this is the result. So this is, again, in the bank-firm relationship. So these are all banks and firms above 25K in the Anacredit. You see that number of observation is about 63 million. In the first, second, and third row, you get the change in lending due to the change in borrowed reserve, credit teasing reserves, and non-borrowed reserves. And then there are controls for bank characteristics, and there are also firm characteristics that are not shown. Now, this type of, in the banking literature, I don't know if you're used to it, in the banking literature, normally you would show a table with progressively increasing saturating variation of the left-hand side variable. So when you move from the first column to the sixth, you are taking out variation. So in a way, you are mechanically increasing, if you want, the R square, because you are introducing a lot of fixed effect. But at the same time, you are controlling for many more things. For example, the last column, which is probably the most restrictive one, when you look at the R square is 0.7, you don't even have to look at that because it's artificially increased by the presence of all this fixed effect. But it controls from the firm time fixed effect, meaning that you are controlling for only the lending to a bank, to two banks to a same firm. Okay, so the control, and this is what normally in this literature is called the Khwaja-Mian type of demand identification. So to control for the demand, basically, just to give you a sense of what does it mean, to control for the demand condition, you really look at two banks that lend to the exact same firm. So at that point, you can, the demand conditions are exactly the same. And if you observe a decline in one of these two banks into the loans offered to the same firm, then you attribute this to the supply and not to demand, because the firms is exactly the same. Okay, so over this six column, you see that the results are kind of robust in the sense that will always point to a positive and significant coefficient of credit easing reserve and non-borrowed reserve to the impact on lending, while it will never deliver a positive or a statistically significant coefficient on the first row. This means that actually then changing in, when you change the borrowed reserve, this will not, again, also in this very granular assessment, will not produce any impact on lending. So just to understand the magnitude of this, so how much are we talking about? So having, for example, a non-borrowed reserve coefficient close to 1 would mean that basically you have a one-to-one mapping between the change in the non-borrowed reserves over asset of banks and the change in the loan over asset. And these two quantity are about, so the total asset is about 35 trillion, so 1% change is 350 billion. This would generate 1% change in the loans over asset. Loans are 4.5 trillion to NFC in the euro area. So loan over asset is 45, again, 3 billion. So it means that when you increase 350 billion non-borrowed reserve, you are expecting to see 45 billion more of loans to firm, that otherwise, if you give to, if you and then simplify even more, every euro you see of increase in non-borrowed reserve, 15 cents of this euro goes into more lending. This is one of the main results, actually, of the paper. Now, this is of course, a cross-sectional, so a very granular result, and you want to understand whether now you can move from the lending to the real economy. So to now go to the real economy, we have to understand whether all this lending produces investment. Or is channeled to which type of firms is channeled? Is channeled towards risky firms, young firms, firms that are able to invest, or what type of firms this is channeled to? And that's the fourth hypothesis, meaning we now try to monitor how the increase in the lending due to increase in liquidity would affect the real economy, meaning employment, investment, and sales at the firm level. So to do that, now we are at the bank firm level, so we collapse the data. Now the firm dimension of the data is very important because it's the one that is of interest for us. So it's not bank lending, or what we are interested in, but it's a firm investment. And what we do is to estimate regression of the type that you see in this chart, where you have the change in an outcome variable. The outcome variable, again, would be sales, employment, investment, would be a function of the lending that they would receive under these various reserve conditions. There will be function of the probability to default of the firms. And that will be also a function of various characteristics in these XFT-1 that are normally the first three that you might imagine are age, size, and leverage. These are the main characteristics that you normally include in this type of work to control for the firm balance sheet characteristics that are in the model. So in this real effect section, what we established that first, QE and quantitative easing and credit easing would be productive, so it would stimulate investment. Second, it would be able to stimulate risk-taking. So you would see that banks would lend to firms that are riskier. And because of that, you want to understand whether this by the way, risk-taking, which is when you do QE, is an intended policy consequences. But of course, what you don't want is that there is an excessive risk-taking. And because of that, we want to control whether the liquidity that would go to firms via the lending of banks that have received via the reserves in QE or the TLTRO are not channeled to unproductive firms or zombie lending. So we'll have a measure of zombie lending and we'll see whether this is true or not in the data. Now we are, again, this is the summary statistics of the data. These are the 2 million observations are the pair, bank firm pair in our data set. And these are the sequence of the variable we use. Now, first result in this, again, you estimate the model that I just showed you. The first result in this table would say, looking at the first row, you don't see star. Second and third row, you see a lot of star. And this means basically that, again, the liquidity that is channeled, so that firm exposed to banks that increase more their credit easing or non-borrowed reserves are the firms that perform better in terms of investment, sales, and employment. Instead, exposure to bank for a firm that exposure to a bank that instead increase the borrowed reserve would not produce any real effect. Now, what you see also in the last column, in the last row, for example, is that the interaction coefficient between PD and the change in non-borrowed reserve is positive. And again, this just means that following an increase in the non-borrowed reserves, firms exposed more to banks that are increasing the non-borrowed reserves are also getting more money when they are more risky. So the PD of these firms is higher. And again, this is connected to the risk-taking channel monetary policy, but you want to be sure that this is not risk-taking, that it is not excessive risk-taking. Now, to do that, we introduce again our dummy variable. It's called the zombie. So we basically measure whether a firm is a zombie or not by looking at whether in the last 3 years, before entering in the sample, the interest coverage ratio of this firm is lower than 1. And of course, if the firm is not young, because of course you might imagine that if you are young or if you have less than 10 years of age, a firm has a higher probability to have an interest coverage ratio, a low interest coverage ratio. So again, if your interest coverage ratio is lower than 1 in the last year, and if you have been in the market for more than 10 years, then you are classified as a zombie. Otherwise, you are a normal firm. Now, notice that this is exactly the definition of a zombie. There's a lot of definition you can use to actually to define a zombie. There are plenty of definitions. Sometimes you even have a slightly different result when you use alternative definition. We use this definition because this was the definition used in the productivity network established in the last strategy review that we conducted at the Eurosystem. So this was the measure chosen. So we just used that. We experimented with few other measures. The results are more or less the same, so I will not be super worried about the definition of zombie, but just to say that this is one possibility of defining zombies. Now, when you introduce zombies in the picture, you see again the first row has not many stars. The second and third row, again, a lot of stars. Again, you have this idea that firms exposed to banks that have a lot of access to either credit leasing reserves or non-borrowed reserves are able to expand more investment, employment, and sales. But then you see that stars completely disappear from the interaction terms in the last three rows, meaning that when you interacted zombie, the probability of a firm being zombie with this access to liquidity because of the then non-borrowed or borrowed reserves is not yet there, is not there anymore. So in this, in a way, would just corroborates the idea that when you have when you do have access to credit easing reserves or quantitative easing reserves, you are channeling, actually banks increase lending, and the lending that they produce is not channeled towards zombies, or is not channeled towards otherwise non-viable firms. Okay, good. How am I doing with the time? Okay, so it's fine. Okay, so probably the last exercise that is actually to refine even more the idea of the link between credit to supply and firm outcome is to have a two-stage approach. So the first stage, we use a bank firm data set, so this 68 million observation. We isolate for each firm the increase in lending exactly due to the increase in the access to the various reserve. So we isolate that lending, and we move then in the second stage from the bank firm data set to instead a firm level regression. So again, we go, first stage is our 68 million observation. We control only for the part that is really more lending because of higher access to reserves. We get this variable, so the change in loans due to the change in reserves. We get this variable, and then we plug into our firm level regression, namely this 2 million plus bank firm relationship that we have in the data set. And again, this is the result that again corroborates the idea that even if you refine even more the liquidity that is channeled, the loans that is channeled to firms via the access to the various facilities, even more, you see that the non-borrowed reserves and the TLTRO reserves are able to increase via this more lending firm's outcome. And firm's outcome, again, are sales, the first three column, employment, the 4, 5, and 6 column, and the investment, the last three column. So, in a way, this is also comforting because the more we try to refine or to robustify our result, the more we get kind of a very similar message from the data, meaning that, again, when you when a firm is exposed to a bank that has increased lending because of the higher share of liquidity that is sitting on, then the firms is able to invest more. Okay. So, conclusion. So, I would like to think of this paper contributing to two different big topics that you might now have seen in the last years, at least, popping up in commentaries, in the policy debate, in the financial market expectation, etc. The first is how a central bank should provide liquidity to the banking system. You might have seen that there's been recently a change in the operating framework of the through which the central bank offer liquidity to bank. Part of this change, and in the press release, you might have seen that the ECB has published or has clarified that in the future there will be liquidity offered via various instruments. And these various instruments include standard refinancing operation, so recourse to the MRO, basically, but also, and this is what is in the press release, if you want, a share of autonomous factor that increase the balance sheet of the ECB would be covered, or the liquidity demand to satisfy the autonomous factor will be covered via structural liquidity operation. So structural liquidity operation means either structural liquidity, meaning TLTRO, or structural portfolio, meaning QE. So in a way, this is saying that by doing, and this to reconnect then to operating framework, by doing QE, or by offering, let's say, by offering liquidity also to structural operating, to structural operation, you will end up having a positive impact on investment, or a positive impact on lending, a positive impact on firm sales and outcomes. The second, actually, strand that we would like to connect this paper is to the under-investment that is now, we have seen many reports talking in the recent year, or in the last year, or actually this year you have seen two reports from the European Commission. They are all saying that European firms, or Europe in general, is not investing at the speed or the level that would be required to stimulate even more innovation and to compete in international market. On this, our angle is that, again, by increasing the recourse to credit easing and quantitative easing, you, and this is in the theory part of the model, you push the firm bank equilibrium towards more a social optimum, where bank now try to invest at the level that is closer to the equilibrium value that we would expect otherwise. And I will stop here. Thanks.
So thank you very much. Are there questions for Carlo?
Hi, Carlo. Looking forward, now that we have started, in a sense, the rundown of the excess liquidity, so you showed in your very first slides the balance sheet of the Eurosystem, and now we have the TLTRO repayments basically complete, and we're running down the APP and the PEP. Have you considered how this would affect, lending, given that simultaneously we're also at a stage where we're cutting interest rates? So if you want me to ask the question a different way, is your model results symmetric? Thanks.
No, thanks. So in a way, yeah. So the estimates that we have are linear. So if you ask a model that is linear, by definition, it will give you the sign, the opposite sign of whatever I've seen for the quantitative easing. So a previous version of this paper was called quantitative liquidity tightening, because we do think that is an understudied topic, the implication of quantitative tightening for lending. And I do think that by retrenching, by decreasing excess liquidity, more and more banks would adapt to this new environment by also deleveraging. So you would have a deleveraging effect. Now, this is understudied because normally when you do quantitative tightening, people or scholars tend to measure the impact on financial assets. Also, they normally go to the real economy by the impact that the decline in the liquidity would produce on financial asset prices or yields, and then by there you go to the real economy. This channel is very different, right? So I never, in all of these, financial assets are never there. So prices of the assets can be the same, but it's really the ability of banks to expand their balance sheet following the increase in the non-borrowed reserve that generates this result. So in a way, if you look at papers that have circulated recently also that look at the asymmetry between QE and QT, they mostly lie, this asymmetry mostly lie on the concept that in the QE, the marginal instrument of monetary policy becomes the balance sheet. So whatever you do on the balance sheet has a lot of impact when you are closer to the effective lower bound, while instead you might have seen that in all DCB, but in all central banks, since they started QT, they have something that says, first, the marginal instrument becomes the interest rate. So it says don't look at the balance sheet to make an assessment on the monetary policy stance. This automatically, if you want, has lower the impact on financial asset. And second, you don't have a big channel, you don't have various channels in the QT that are instead present in the QE, namely the signaling channel, for example, or the stock effect. So if you want, but this is another literature, just to complete the reasoning. So when you want to understand the implication of QE on a financial market, you normally have that most of the impact even come in anticipation of the actual purchases taking place, because it's the stock or the envelope that you're announcing that you will buy that move the market. While in all the communication of central banks, and this is ECB, Fed, Bank of England, you will always find that the pace of the reduction of the balance sheet is gradual, measured, predictable. All these words would tend to, if you want, to lower the impact of the stock effect and isolating only the impact of what is called in this literature flow effect.
Other questions? Otherwise, I have a question. So one question is, like, if you ever tried for the third hypothesis to do some interaction terms with bank characteristics to see whether this lending channel is somewhat asymmetric or is more powerful with banks with some characteristics rather, or in some jurisdiction rather than others. And the second question is, if you can say something about this, say, extra provision of credit coming from non-conventional policies is more like on the intensive margin or the extensive. So there are new loans that will not be given, or is like the size of the loan that gets bigger?
Okay, well, thanks. So the first question, yes, in the paper we have, so when you do these papers on banking and firms, again, you always interact, whatever you have, it's very easy, you always interact with capital, liquidity, and size for the bank, and size, age, and leverage for the firms. And what you always end up having is that fragility of banks and firms amplify the transmission. So balance sheet characteristics of weaker bank would be always the one that transmit more or increase more the lending when you do QE, or decrease more the lending when you do QT. And this is normal because it's there in these fragile banks that you unlock more possibility to extend loans when you do QE. But the same is true also again for the firms. The ones that are benefiting are always the younger firms, and this is very important if you want also for the policy perspective, because these are typically the ones that are more investing in R&D. So you are really pushing, channeling the money through to the firms that are more able to then produce innovation. And the second was, what the time again? No, yes. Yeah, so in this model, so this is intensive margin. When you do extensive margin, you have to do something that technically in this word is called rectangularize the data set. We have done it, is also falls through. So you would have the same.
You say that given this heterogeneity between banks, if I understood correctly, there is, I mean, with quantitative easing, there is increased risk, basically, in the economy, because you are, essentially, these go more towards weaker banks and the weaker firms. I mean, from our perspective, for example, locally, we observe that actually, although our banks are highly liquid, we had participations in TLTROs, but it's not, the result was not more lending, but simply banks benefited because of you mentioned the 1% negative rate, which basically made them gain an extra half percentage points from their excess liquidity, from paying the half percentage point to the central bank. So it's not that it wasn't the case that it increased lending for sure.
No, so this is exactly why I have done this exercise on the zombie lending. No? So this exercise would tell you, so when you say following QE and TLTRO, funds were channeled to a weaker bank. This is in the idea of channels of transmission. This is, again, is the risk-taking channel of monetary policy. So it's an intended policy target to increase the lending towards more risky firms, meaning that otherwise you will not lend to these firms. Now you have more money, you lend to them. And by lending to them, and again, more risky means, for example, younger firms. Now, is this conducive of excessive risk-taking? That's what we don't find in the data. So, but this is exactly the big issue of this type of policies, to measure whether you stimulate risk-taking or excessive risk-taking. In our data, we don't find, now I've not run the model, although I can do it easily for Malta, so I don't know exactly the situation in Malta, but in aggregate, that's what we don't find.
In your BVAR model,
Yeah.
I've seen one of the variables, which is security over assets.
Yeah.
That I'm assuming this is sort of a proxy for the liquidity generation capacity. My question is sort of whether do you control whether these securities are encumbered or not, whether they are ECB eligible.
Oh, this is just from the balance sheet of the bank. I take security over asset also to control for the exposure to the QE. Because of course you might imagine that when you do QE, a central bank take out the security from the hands of the bank, so it would generate also some movement there.
But it has to be unencumbered.
Yes.
That's why I'm
Yes.
And another question, regarding the local projection model. I'm not sure whether maybe I missed it, but do you control for liquidity generated not from the wholesale side, not from the interbank side, but from deposits, retail deposits, for example? Or obviously, maybe in the total scheme of things.
So its deposit is the same. So it's there, no? I mean, because everything would be
is
there.
included there.
Yeah, it's actually there are a lot of controls that I have not talked. Also in the bank, in the individual bank result. One is that. One is the even matched with the, because to control for the demand condition, for example, we matched with the individual replies in the bank lending survey on the credit demand conditions. We control for the deposits over assets. I mean, there are various controls that we do there.
For Malta, for example, that would be an interesting dimension because much of the liquidity is coming from the retail side. Okay.
Hi, thanks, Carlos. So I'm really interested. So there's a lot of material, but I'm really interested in what you showed that basically borrowed reserves have no effect on lending, and I was wondering whether then we should be in a sense worried about the conventional transmission mechanism of monetary policy in the sense that the stance, the monetary policy stance, is the DFR, and the MRO affects the standard operations, which have, from your results, have no impact or very little impact on lending. So I guess should we be worried, or are there are other channels through the Mali market, for example, which circumvents that effect?
So I'm not sure I get so. So your worry is you're talking monetary policy stance or the operating framework?
The operating framework.
Operating framework, if there is no lending, is even fine. So actually you design an operating framework to be stance neutral. So it's fine if you don't have impact. The problem is when you instead want to observe the stance effect. And in that moment, you can do it only via QE and credit easing. So that's more or less the result. So in this sense, you don't have to be worried about. So there is no weakening of transmission, of standard transmission.
Hi, I'm Giovanni Farrugia, treasurer by profession. From one of your slides, we see that the MRO became a little bit irrelevant when LCR and NSFR regulations were introduced, circa 2014. Does the ECB consider rethinking such monetary operation tools for banks to have a more general take-up of these facilities? We see that LTRO, I think it's 3 slides from this. LTRO was being used more actively when the MRO basically became irrelevant, and the LTRO was a massive success, potentially because of the benefit, financial benefit for banks. Does the ECB consider rethinking such of these tools?
So what the ECB think, I am not in a position of telling you. I can tell you what is in this model or in this paper. So if you project this ahead, or actually, maybe I can tell you what the SMA or the Survey Monetary Analyst, which is a survey that is done by the Eurosystem, would tell you. They would tell you that there is a projected increase in the access of MRO and standard refinancing operation in the coming year. But this has nothing to do with what the ECB will say. That is more a governing council decision that any of us can understand or talk about.
Thanks, Carlo, for this presentation. Two short questions. I don't want to be long. First, I know that you didn't go through it because of time concerns, but what are the theoretical underpinnings for banks' reluctance to go into these, to borrow? So is it only stigma, or do you?
No, it's actually, there is no stigma in the model. That's the beauty of the model, that you don't have stigma. You have just the inability of banks to understand, to incorporate the social impact of their action.
You don't just go into putting in adjustment cost, like, no, just, okay. And the second point is on your BVAR and panel BVAR results, because there you claim, the second hypothesis, that an increase in borrowing of commercial banks from central banks is not conducive to increased lending. And you showed that those IRFs where you shock industrial production. Correct me if I've understood this wrong. However, that is not a counterfactual argument. No, so we cannot say whether credit would have been lower or higher had there not been TLTROs, for instance.
No, TLTROs is not there. There is no TLTRO in that exercise. That exercise is just. Let me see if I. So this exercise is just you get. There is only borrowed reserve, by the way. So it's only banks going to the central bank to borrow. There is an adverse shock, and to the adverse shock, banks react by going, and that's the only things they can do, because we are mimicking what in the theoretical model is the lender of last resort regime. So the only things they can do is to go to the central bank. They go to the central bank. They increase the borrowed reserves. That's these things. The top left chart, you see that they increase in borrowed reserve, but at the same time they decrease the lending. So at the same time they would not use this. You might imagine that in the model there is some endogeneity because of the lags, whereby when you increase borrowed reserves, this then would be used by banks to increase lending.
But this does not mean that had there not been the opportunity for banks to go to the lender of last resort, it might be the case that loans to firms would have been even lower. No, so it could.
Yeah, it could be.
It's not saying that borrowed reserves played no role. In a sense,
no, it's not saying that played no role. You mean that in the counterfactual, this would have been a collapse in lending in absence of that? Yeah, it can be, but it's still in line with our assumption. Okay. This would be still in line with the model.
Thank you.
That is true.
So thanks again for your approach.
Thanks, sir.
So welcome back to the last session of this program. I now invite Massimo to the podium to start the last session. He will be presenting the transmission of Eurozone monetary tightening to mortgage rates, how Malta differs. It is a joint work with Nathaniel De Bono and Germano Ruisi. Yes.
Okay, thank you. So yeah, this is joint work with Germano and Nathaniel. The usual disclaimers apply. And okay, brief outline of the presentation. There will be a little bit of motivation introduction, some description of the data that we're using, the empirical approach, some results, and time permitting, we will go through a little bit of robustness checks, and then I will conclude. So, as part of the motivation, there is a graph that is very similar to the one that we've seen in Carlos' presentation, with the developments in the recent couple of decades of monetary policy rates, which are, in our empirical world, will be proxying with the 3 months Euribor rate, which is the yellow line. And we also put like inflation rates, HICP inflation for the euro area overall. And okay, as we all know, starting with the post-pandemic recovery, together with energy crisis, supply chain bottlenecks, and Russian invasion, and so on and so forth, HICP skyrocketed, and then therefore the ECB started to react, increasing rates until September 23, when the DFR reached the 4 percentage points, and they remained stable at the level until last May, before the cut of 50 basis points in June 24. So our analysis will be focusing on the gray area that you can see. Okay, so, sorry. So in response to changes in monetary policy in the last couple of years, in this paper we want to explore and to study a little bit what happened to mortgage rates in the euro area. So here you see in the red line the 3-month Euribor, which is our proxy rate for policy, and you have like a shaded area, which has basically the bank level range mortgage rates in different jurisdictions of the euro area. And as you can see, there are countries like Estonia, Lithuania, Latvia, in which basically the mortgage rates were mimicking almost one-to-one the behavior of the Euribor. Instead, there are other countries, in particular Malta, in which we have mortgage rates, which basically their band of mortgage rates has been constant over time. And as you can see, like from this picture, there is a certain degree of heterogeneity, both across countries and also across banks within countries. So you see countries like France, Germany, Cyprus, and Spain to some extent, in which the variability within country across banks is increased as the policy rates were increasing. So this is like a little bit of motivation. And to further feed the motivation aspect of this paper, even if you are not going through the analysis of volumes of mortgages, this clearly has implication also in heterogeneous lending, mortgage lending conditions. So by and large, the vast majority of countries you've seen, like you see the red line, is the new business mortgage lending normalized at 100 in January 2022, and the gray line is the country level average mortgage rates, and you see that in most countries there is, of course, a negative relationship between rates and volumes, whereas in Malta, clearly, since rates were not moving, also the provision of credit for mortgages didn't move so much. Then, of course, again, there is some heterogeneity, but this is not in our empirical work. It was just to say, like, heterogeneity in mortgage rates have real implication in the provision of credit. So the paper that we have can be summarized in one slide with 2 questions and 2 answers. So the first question is, what bank-specific characteristics can explain cross-bank heterogeneity in the transmission of monetary policy onto mortgage rates during the last tightening cycle? So our analysis is for the latest tightening cycle. And second, whether this bank-specific feature, if there are some that can explain heterogeneity, can help us explain why Malta has basically zero pass-through in mortgage rates. And the results are that across different bank characteristics that we are exploring, there are 2 that are statistically significant. One is liquidity, and one are deposit rates, the level of deposit rates. And these are identified as main drivers of recent heterogeneity in the transmission of policy rates onto mortgage rates in the euro area. And once we take into account the levels of liquidity and deposit rates of Maltese banks in our sample, we can explain approximately 40% of the gap in the pass-through of policy onto mortgage rates between euro area banks and Malta. Okay, so if you are bored, you can just take this away and think about your weekend. Otherwise, we go and I can say something about what data we use. And basically, the data that we're using are bank level data, which have been also used by Carlo, in particular the balance sheet items from the IBSI database. And you also use bank level data for mortgages from the IMIR database. These are confidential bank level data for the 19 euro area countries. Croatia just joined, so we don't have data for Croatia. Of course, the interest rate data for some banks, small banks in particular, they were a little bit erratic sometimes, so we had to do some cleaning process before doing the empirical analysis. And, okay, we don't have time now to go through what criteria we used for cleaning the data, but we are confident that the banks that survive our cleaning, which are 145 banks, are a good sample that is representative of the aggregate behavior of mortgages in each country. Of course, with no surprise, bigger countries have more banks, so Germany, France, Spain, and Italy are the countries which have a larger number of banks, and Malta, after the cleaning process, we have 4 banks that survive our cleaning process. Summarizing, our analysis is going to be a panel data set with 145 banks, with the covering the period between July 22 and May 24. And okay, there will be some robustness checks that were done, and our results are pretty robust to that. So, since we are after characteristics of banks that can explain the heterogeneity in the setting of mortgage rates, we want first to have a look at how these bank characteristics that we're interested in are distributed across countries. So, in the top graph, you have liquidity ratio, capital ratio, deposit ratio, and sovereign exposure, so holdings of sovereign bonds. And the green dots are all the euro area countries, but Malta, which is the red dot. And the zero line is the characteristic of the theoretical average bank across euro area. So you can see that liquidity, so Maltese banks have higher liquidity than the average euro area bank, slightly average capital, a higher deposit ratio, and higher sovereign exposure than the average bank. Whereas, when it comes to deposit rate and initial interest rate, so the interest rate on mortgages that were at the beginning of our sample, we see that Malta has a relatively lower than average weighted average deposit rate and a slightly higher than average initial rate on mortgages. What is the empirical approach that we use? We are using an error correction framework following a paper by Halton and Dacry. And basically, I probably will not have time to go through all the specifications. Basically, these models distinguish between short-term pass-through and the overall and long-run pass-through. And the short-term pass-through is summarized by the beta coefficients, whereas the long-run pass-through is basically the ratio of the delta and the theta parameter in this estimation. And so on the left-hand side, we have mortgage rates, and on the right-hand side, we have lagged mortgage rates, we have contemporaneous and lagged policy rates, and also some macro controls that are used to avoid the possible economy-wide condition that can blur the estimations. Our regressions are weighted by average new business mortgage volume, so this means that not all the banks in the panel, they count the same. So larger banks, so banks that provide more mortgages are relatively weighted more than the smaller banks. And we use a panel OLS with heteroscedasticity consistent standard errors. So here, in this specification, you see that there are no bank characteristics. It's just rates, policy rate, and macro controls. So this model is used to give a first pass estimate of the pass-through of policy rate in the euro area, and that is column 1, which basically has a short-run pass-through of 0.386, which over time will reach 0.459, and this, with the stars, it means that it's statistically significant. Once we add to that equation a dummy for Malta, so that we try to estimate potential differential pass-through both in the short term and the long term for Malta, we see that basically the pass-through for Malta is statistically not significant. So there are no stars next to 0.365 and 0.13. And this is not surprising, given like the first graph that I show you, in which mortgage rates were pretty stable over Malta. So this is saying that ignoring, not accounting for characteristics, there is a pass-through that is not statistically significant from 0 for Malta. Then, we want to ask ourselves whether, allowing for some interaction terms, which are the Z of the bank characteristic with the policy rate, we can find some differential effect and some extra explanatory power that bank characteristics can help us to explain the pass-through of policy rate to mortgage rates. And so you will see that the Z variables are going to be used as control standalone and then will be interacted with beta and the delta MR in order to have this differential effect. First, we will run this regression using bank characteristics one by one, and then we will do a second estimation using all the bank characteristics jointly. So these are all the estimations that we are done with. Each column is a different bank characteristics, so liquidity, capital, deposit funding, with deposit ratio and deposit rate, and size market share of the bank, sovereign exposure, and so on and so forth. And as you can see, there are only two columns in which you find red numbers, and are liquidity and the deposit rate, so the second column of the deposit funding part. And zooming in, the interpretation, you should go and look at the bottom part here, those 0.090238. That means that in the euro area as a whole, the pass-through of a bank which has a 1 percentage point higher liquidity than the average theoretical bank in the euro area is 0.9 basis point lower than average bank. So basically the idea here, this is like some results that is already existing in the literature. So higher liquidity banks are like healthier banks, and therefore they have less need to pass through changing policy rate into mortgage rates, so that they can stay competitive on the market. And when it comes to the second column, which is the deposit rate, we have that the pass-through of a bank whose deposit rate is 100 basis points higher than the average bank in the euro area is 23.8 basis points higher than the average bank. Here the reasoning is the opposite. So if a bank, our understanding, our conjecture is that if a bank needs to pay higher deposit rates, it means that on average has higher time to collect funds, so it's a little bit weaker, and therefore by having to increase the deposit rate, it has also to pass through more in order to keep the profit margins. Then we do the same estimation, but allowing for the joint presence of all the bank characteristics. And again, the two characteristics that are statistically significant from zero are again bank liquidity and deposit rate, with coefficients which are with the same sign and the absolute value a little bit larger, suggesting that probably there is some correlation in the regression, that basically there is some compounding effect that is going on there. Again, the intuition is the same as before, so higher liquidity. Banks with liquidity higher than the average theoretical bank pass through onto mortgage less, and banks that charge higher or pay a higher deposit rate more than the average European bank passes through mortgages more. Then the question is, can these two characteristics, so liquidity and deposit rate, can they explain the gap between, what we estimated for, so the zero pass-through for Maltese banks and the pass-through that you have on the right spectrum, which is 0.3 something for the euro area, considering deposit rate first, liquidity second standalone, and then put them together. So what it turns out is that when we use the liquidity levels of the banks in the sample, we average them by their size, and we apply the estimated coefficient that we have from the estimation, we have a fitted value of what would be the expected pass-through for Maltese banks, which in that case will be for deposit rate and the liquidity standalone 0.317, so 17% less than what we estimate for the euro area as a whole. When we put and we consider the two characteristic, liquidity and deposit rate, so we try to compute the fitted average pass-through for Maltese banks using the coefficient on estimation run on the euro area, we can explain up to 41%. So basically, those two characteristics are able to explain 41 percentage points of lack of pass-through of Malta with respect to, so there is a 59% that is still unexplained. As a robustness exercise, we do an alternative formulation, and we do an alternative regression in which is more short run, so there is no long-term convergence. And so we go away from co-integration relationship and so on and so forth. And we change it a bit. And so on the left-hand side, there is no longer the mortgage rate, but there is the spread between mortgage rates and the Euribor. And we try to explain and to see whether the bank characteristic that we found as significant in the previous exercise, the error correction, are still significant. And this is what we find. So basically, we do the estimation jointly and on the left-hand side and together. And again, the size and the signs of the coefficient attached to this characteristic are exactly the same, similar, but the signs are the same of the previous one. This basically is a robustness check to say, okay, let's try to look at the problem from a different perspective. So instead of having policy rate on the right-hand side and mortgage rates on the left-hand side, let's do the difference, the spread between them, and let's see if this characteristic can explain the heterogeneity in the spreads in the euro area. Then we do other robustness checks. So our indicators using balance sheet information, we proceed with different type of aggregation. So we have a measure of liquidity, which are like narrow definition, broader definition. We have a different definition for size and market share, and all our results are robust to these different proxies. We replicated the same analysis not by starting in July 22, but starting in January, so before the hiking cycle actually started. And again, we find the same empirical evidence. We played a little bit in the error correction model with the lags. So the results that I've shown you allow for current and T-1 policy rate to have an impact on mortgage rates. And we played with removing the T-1 or adding a T-2, and the results carry over. And then what else? What did we do? We change the weighting schemes. So we do a battery of checks, and it seems that these two characteristics are the ones that seem, from the data that we have, speak more about the problem that we are trying to understand. So conclusions. So the main takeaway is that, so this probably, actually for sure, is the first study conducted in Malta using bank level data from the data set. So that's already, so we were the first one to try to play with this. And we wanted to exploit the information in the balance sheet of euro area banks to try to explain the heterogeneity in the pass-through from policy, proxied by the Euribor, onto mortgage rates. And we find significant robust evidence that the two characteristics in the euro area that explain this heterogeneity are liquidity and deposit rates. And once we plug the values of this balance sheet and deposit rates for Maltese banks using coefficient estimated for the euro area as a whole, we can approximately explain 40% of the lack of pass-through that we find it for Malta. There are a couple of remarks that we have to, I would like to point out. So firstly, our estimation assumes that Maltese banks behaviorally are identical to euro area banks. So we are not trying to estimate particular marginal effects that are attached to Maltese banks. One reason for doing so is that the sample is very short, so we have only 4 banks in Malta, and there is lots of heterogeneity, so it's possible that we are not confident that those type of trying to estimate the particular behavior of Maltese bank can be accurately accounted for. And then second thing that we want to do is try to take into account potential nonlinearities in two ways. So try to play to possible 3-way interactions to see whether there are some incremental effects, nonlinear effects, putting together characteristics. And the second type of nonlinearity that we may want to explore is to put quadratic curves in order to see if your bank is very much distant from the average euro area bank has something to explain more than assuming that this distance is linear. And then again, of course, we would like to extend this work also to lending to NFCs and to deposit rate setting so that we have a global picture of how bank characteristics can explain the different impacts on the different rate settings both for lending and deposit rates. Thank you.
Thank you, Massimo. So we open the floor for the questions. First Carlo and then Alan.
Oh, thanks. That's very interesting. I was looking at the data from Malta, actually. So it looks like as if the transmission for firms.
Do you want me to go to some plots or?
No, just a question. So the transmission to firms looks like kind of fine. Transmission to households looks affected through volumes. So if you look at volumes, you have a 5 percentage point decline from when the ECB started to increasing rates to the staff. And then you don't have any impact on lending rates.
Mhm.
Now, I was thinking whether, because lending rates in a way is a bit of a suboptimal indicator of transmission, because you only have a price when first you are not discouraged to go to a bank, second if a bank gives you a contract. Do you have any idea on whether, because the volumes have gone down, like in terms of annual growth rate?
But these are the volumes for Malta for mortgages.
Yeah, and they are different from my one, but it's
These are new business like the.
But in any case, do you have any indicator of like the rejection, or whether they?
Here we are using INIR and IBSI data.
No, that's why I'm saying it. But you can find other, even in SAFE, for example, or other service where you can, or in the BLS, you can check whether the rejection, if the rejection increase,
Okay.
or whether, and the second is whether they are doing the cross-selling. So various banks, for example, what they do, they keep lending rates constant, but they increase some other fees with the same. So
Yeah.
this type of.
Okay. Yeah. No, we didn't look into that. You want? Aaron? Alan. Yeah. So the macro controls that we use are unemployment rate, the market concentration, the first differences of HICP inflation, of unemployment rate, and the 10-year government bonds. These are standard, say, macro controls that are used in the literature. We also included the unemployment rate because it should capture a little bit of a risk channel. So countries that have higher unemployment rate, there is sort of a high probability of default because people can lose their job. So this is what.
Perhaps you could test for example, profitability as well.
But profitability
Lending,
at the bank level,
yeah.
yeah. But so these are macro controls. So are controls that are basically applied to all the banks within a country.
Okay.
And instead of in terms of the characteristics,
But still, you can have an overall profitability rate, which we know, for example, we know that the profitability rate of Maltese banks is higher than the EU average.
yeah. So profitability, we can also compute.
Same things for MPLs, for example, asset quality.
Yeah,
And the loan and deposit margins.
yeah. That I think
because
is right.
these are things that sort of are very characteristics of the Maltese system
Yeah.
as well.
In fact, we have also estimation, we didn't show here, in which on the left-hand side we have the interest rate margin between lending and deposit rate, and more or less we find similar.
And what struck me sort of is that concentration, if I'm not mistaken, is not significant, if I'm not mistaken, or market share.
So, yeah,
Is it?
allora.
I
So,
would have expected sort of to play a role.
so market share is not, like the interaction of the market share with the the policy rate is not significant, and the same applies. So there is a slightly coefficient which is significant in the relevance of mortgage market to the bank. So basically it is the how intensive a bank is in the mortgage business.
Massimo,
Yes.
I had something. So we control for kind of two sets. So from a bank perspective, we control for this loans market share. So it's the balance sheet item, which is basically expresses bank loans relative to the overall loans in the market. And at a bank level, that is not found to be significant. But then we also control for the concentration index of the market. So for example, Malta is quite concentrated in terms of banking sector. And that, as a control, we don't show it because we don't show the results for the controls. Yeah, but
Yeah,
yeah,
it's
the market
positive.
concentration is positive. So more concentrated banking markets, they actually will find that they have had higher changes in interest rate. Also, to say something about the profitability, we couldn't consider that because we use balance sheet items data. And there is basically no variable in that data set which we could take to proxy the profitability of the banks.
Also,
First of all, thank you for the presentation. I mean, maybe I'll try to put, some provocative questions on the 60% unexplained.
I was
I
expecting
mean,
that.
let's put ourselves, we are a generation coming from a narrative that we are a very small open economy vulnerable to shocks, which means that as a country we are very much aware of shocks and therefore to preserve against shock, to safeguard against shocks. And you have which are the two biggest players in the economy? The government and the banks. The government has tried everything to ensure the economy against shocks, pandemic, inflation, just anything. And I think banks have the same reasoning. Keep in mind the channel, a concentrated banking system means that banks can afford, if you want to use that word, to have a long-term view. So interest rate stability is a feature which has always, the only change in interest rates which there was when we swapped to the euro and basically the risk premium came down. From then on, a generation of bankers has always assigned importance to stability, which is something which has worked. So it's actually part of the objective function of the banking system and say, listen, a stable interest rate. Now, it had worked before on the downside, so obviously the downside, there wasn't the full pass-through either. So I think we're seeing, the normal situation. There was no limited pass-through in the past, limited pass-through in the present, and I would think that there would be limited pass-through as long as the liquidity conditions continue to afford it. So I think if we put that at the mind, we'll be able to explain the remaining 60%.
So just a comment on what, I understand. So let me say a couple of things. And this is me and not the Central Bank of Malta speaking. So if there is a little pass-through, like during normal times in which basically monetary policy was accommodative and there was not much going on, low inflation, low interest rates. The fact that maybe the business model of Maltese banks or banks from other jurisdiction followed some sort of usual business, that's fine. The question is, we wanted to check whether under the last 2 years it was very different because there was the ECB was trying to fight inflation and also in Malta there was sensible inflation. And so then the question is from the policymaker, I guess, whether the behavior of commercial banks was functional to the objectives that the policymaker has, right? So there is this tension. So also because, and for us to try to understand and try to find what characteristic may be the drivers of this heterogeneity and how much they can expose the behavior of Maltese banks can be informative for policymakers and could be like something that also commercial banks may try to have a look at.
if I understood correctly, you took, there are two criteria which accounts for 40% of the difference, which is the liquidity and the deposit rates. What I'm asking myself is that deposit rates is the effect of liquidity. So the more liquidity there is in the bank's balance sheet, the less likely it is to increase its deposit rates.
Yeah, there are some.
So isn't there an element of, cause and effect there, which is an element of double counting? And if you were to take just the liquidity concept on its own, how much would it explain?
Yeah, so this is exactly in this slide. So when we look at deposit rates and liquidity by themselves, so one by one, individually they can explain 17%. 17% of the gap in the pass-through between the Euro area banks and Maltese banks. When we put them together, it's not 17 times 2, so it's not 34, but it's 41. So this is suggestive, as you say, that there can be some sort of compounding effect between deposit rate and liquidity. Okay? Yeah, so this is the case. The point is that we believe that if banks need to charge deposit rates, or say pay deposit rates which are higher than the average of the competitors, it means that this individual bank is a little bit struggling in getting funds, and so therefore it has the implicitly needs to pass through more on the lending rates in order to keep the profit margins. Whereas like a bank that can have lots of deposits because, I don't know, there is a very strong relationship with the clients, they don't need to pay deposit rate because the institution is trusted, and then therefore they have less necessity to pass through changing in policy rate into lending rates. Yeah. Yeah, so the other 60%. So we don't know. So the honest answer is that we don't know. I can say 3 possible arguments that can be suggestive, but we didn't, empirically, we didn't test because we couldn't do so. So the first thing is that we are assuming that the behavior of Maltese banks is the same as the behavior of any Euro area banks. So if there are some specificities that go beyond the characteristic that we are looking at, that is not accounted for. So that's one possibility. Second, another way to think is that maybe banks in Central Europe are more connected, and so there is like more international banking going on. So there are banks, French banks that operate in Italy and vice versa, and that can sort of induce some spillover effects and some more homogeneous behavior, whereas in banks, as far as I know, there are only domestic banks, and this type of, import of policy of banking behavior from other countries is non-existent. Whereas, like for instance, I know that for the Baltic countries, this is very, very present. And the third possible way that we are not exploring is that maybe there is heterogeneity across Euro area banks, and maybe make a case for Malta in the access of deposit facility of the ECB, and so maybe you have some banks in some jurisdiction that make use of this deposit facility to a larger extent than others, and this could also have some implication in the interest setting on mortgage rates. So these are 3 possible avenues in trying to figure out what is that 60% made up. But if you have other suggestions, you have another suggestion? Yeah. Yeah. Yes.
Hi. So just to, Andrew from Financial Stability, just to clarify, comment a bit on what you said as well. The market margins in Malta is quite different from in the rest of Europe and how setting the interest rates are set. We always get these questions from our interactions with foreign institutions where our banks have their base rates, and these have to be consciously changed from the bank to pass through the pass-through of the mortgage policy, while other countries might have, in fact, as we saw, there is a one-to-one almost relationship between the Euribor rate and the mortgage rate. So in some instances, this, for countries, the setting of the interest rate would be automatic. The variable interest rates in the mortgage is actually variable in the sense that these are linked with market rates, and an increase in market rate would result, as we saw in, for example, Lithuania, an increase in the mortgage rate set for Malta, this is not the case since the variable rates are set with the base rates, which need to be consciously changed. Having said this as well, we saw, of course, differences in the pass-through on the deposits for some of the banks, but not in the pass-through of the mortgage rates. All domestic banks kept the mortgage rates, base rates stable. There was one bank who changed the margin, but otherwise the base rates remained the same. While deposit rates for some of the banks, particularly these which have lower deposits and lower liquidity, was higher, and they issued higher rates to attract, of course, more deposits compared to the other banks which had the luxury of having a high liquidity, which collaborates with the results. So I think this difference in how the Maltese market operates is also one of the reasons why there is an explanation, the 60% basically, which is not explained by liquidities. The fact that it's a different market in how it operates compared to other countries.
Yeah. One thing just to, so in this graph, we use, and also in the empirical analysis, we look at new mortgages rates. So the fact that the rate is variable or not, we take into account because we control also for the share of relatively variable rates. So we have one of the controls is the fixation, and basically it's the share of fixation period loans with less than 1 year. And that is exactly to try to capture, like, if the interest rate setting on the new mortgage is somehow function or can be explained by the type of contract that you have, if it is more a variable or a fixed rate. But I agree that there is a different function that with this data is difficult to extract.
What about the funding of banks? Because there could be differences in funding across banks between Malta and Europe. I don't know whether this is the case, but something that will be investigated. But, for example, here the banks, at least, let's say what we call the core banks, which are involved in mortgage lending, most of the funding is retail deposits and demand deposits, which is carries zero cost. So if you have other banks in Europe where they might have a proportion of retail funding, but maybe it's more term deposits where of course the pass-through maybe there is there. So of course, I mean the response could be different with respect to. So it's not just a question of liquidity, but it's the structure of the funding of the banks.
I don't know. Do we have that information in the DSI from the composition of the funding for banks, like term deposits, retail?
Yes, so we have distinction, so whether it's time or overnight deposits and by institutional sector. We also have, with the exception of the French banks, the borrowing from the central bank, from the ECB.
And this is something that we are.
It's more. In fact, is more than 50% is overnight deposit. More than 50 is a lot. We have a lot in the time deposit. Like the overall liability is 44 billion. The overnight deposit is 21. The time deposit is 5. So it's that is a lot of overnight.
Overnight, yeah. Yeah. So maybe we can try to do some.
And probably the loan to deposit ratio as well is low. In Malta, it's very low.
But that we take into account.
It is low. The difficulty, and that's why we didn't consider a loan to deposit ratio, is that there is actually quite a lot of heterogeneity in the sources of funding of banks, as you were saying, Mr. Damarco. Not just in Malta, but also in the euro area. Yeah. So there are banks which don't really rely on funding by, don't really rely on deposits by households or NFCs, but may simply depend on, let's say, intra-group funding, for example. So it was quite difficult to create a loan-to-deposit ratio without getting some strange results for some euro area banks.
Hi, first of all, well done for this and thank you for bringing this topic for discussion because it is very relevant in the sector, definitely. I think by classifying Maltese banks together.
Sorry?
by classifying Maltese banks together as a one pot. I think that really hinders a bit the analysis, because in the local sector there is a big divergence between the largest two players and the other players, and apart from the other two, because I believe you only focused on the largest four, there are other smaller banks which in the period also increased their deposit rates. So it was more an effect of the largest banks which had a lot of liquidity not passing through, while the others trying to attract deposits. I believe an interesting point that might be sort of an add-on to this would be a study to understand why in this period, when the other banks started trying to attract deposits, so they effectively tried to pass through. This didn't happen in actual fact, because the amount of deposits that were held at zero interest rates didn't move didn't move in volumes, because there were smaller shifts from time to time. But to me, that is sort of the biggest question that one should answer, because ultimately, if there is a case where a depositor is happy keeping the money at zero, while other banks are struggling to attract money at 3%, what is the incentive for the bank to actually increase its rates if depositors aren't even moving the money? So ultimately, I think if we were to ask ourselves why the pass-through didn't happen, we also need to see that if ultimately the depositor didn't react to the wide range of attractive deposit rates that were being offered and even marketed in media, etc. So ultimately, there was no financial incentive to those banks which had already a lot of deposits to try to attract even more deposits by increasing rates.
Yeah.
Thank you.
Just to, so our analysis, our empirical analysis is at bank level, but using all the banks in the euro area, and among the 145, we have 4 Maltese banks. Okay, so the analysis is at bank level. Clearly, the weight of Maltese banks in the whole sample of the banks considered in the euro area, so it's very likely, actually, we know that the coefficient, the estimates, by including or removing Maltese banks is not going to change. So that's one thing. And given that our cleaning, data cleaning process let us work confidently only with 4 banks because of data quality, in this type of study, we cannot explore behavior of smaller banks, or the banks that didn't survive the analysis because they didn't pass like a data quality check in the database that we have. So those are 2 caveats, but I understand the reasoning that
I'm really sorry. I think this needs to be the last question, because
Okay.
otherwise...
Okay.
With the interest rate, so if I understand correctly, you use only data of new loans?
Mortgage.
Yes, new mortgage loans. And what was the interest rate? Because in the last 3 years, we have seen local banks having a bit like a teaser rate. So let's say for the first, depending on the bank, the first 2 years, the first 3 years, up to 5 years, you have a much lower interest rate, typically 1%, and then it goes up to a higher average interest rate. So what did you consider?
So we take the database constructed by the ECB as given. So what my understanding of it is that it should be the interest rate that, so is the average interest rate charged by a bank in a month for a mortgage. Okay, so, and is the rate at inception of the mortgage. So we don't keep track of the evolution of the outstanding mortgage rates. Okay, so it's just the rate at inception across the mortgages given by a bank in a certain month. That's my understanding. I don't know if...
Because I think that might be a big part of the explanation of the 60% unexplained, because given that they started this new way of pricing the loans, on average, the interest rate would be much lower. The second item is on the market share. So how did you measure the market share? So let's say if you have data for 4 Maltese banks, in any given month, did you look at all the loans granted in value, and then you calculated the market share depending on these banks?
So we think we played with the different measures of different proxy for the market share.
It's the overall.
It's the overall?
It's the overall, so the denominator would have the
total?
overall loans given in the Maltese market during the month. But it's based on that one's based on the outstanding loan. So it's a measure of how powerful a particular bank is in the Maltese market. We also tried it with based on the new business loans, but essentially the results don't change. So, regarding the interest rate, we use a measure of the aggregate rate as published by the ECB. So that takes into consideration the different fixation periods and also the volumes. So they calculated kind of the weighted average of the different fixation periods as well. So the rate we take considers that the rate might change after an initial fixation period.
Okay. Thank you.
Now Valerio will present his and Valentina and Warren's work on intergenerational transfer. It's the title of the study is The Impact of Wealth Transfers on Home Ownership in Malta. Valerio.
Thank you. Okay, so let me try. Yes. Okay, so good afternoon, everyone. Thank you, Noel, for the introduction. And yes, so the topic of the research that I'm going to present, and I performed that in collaboration with my co-authors, Valentina Antonaroli and Warren De Guara, investigates the relationship between wealth transfers and homeownership in the country of Malta. So, even in our case, a disclaimer is that the results that we obtain represent exclusively our views as authors and not necessarily the ones of the central bank as institution. Okay, so the structure of the presentation goes as follows. So we would start with an introduction and providing some basic motivating facts that led us to be curious about this research. Then we would move on to the data that we used, which is the Household Finance and Consumption Survey, and some first descriptive evidence, which we obtained with it. And then we will jump to the core of our research, which is, of course, performed econometrically. So we will show all the regression specifications that we performed. And then before concluding, we will provide a series of robustness and sanity checks, which show that our results are not the result, are not caused by any of our assumptions that we performed on the data. Okay. So the motivating facts. So Malta's housing market, and Malta in general, as you may know, in the last decade, it has experienced a quite sharp population growth. And this factor, together with a limited availability of land, has caused, among other factors, a sharp increase in the property prices. As a consequence, and this is shared by many other developed countries, homeownership is becoming much more of a challenging prospect, especially for younger households. And in Malta, this is even more relevant, with strong cultural preferences for homeownership over other forms of habitation, mostly renting. And again, so in a context of strong familiar ties like Malta, financial support from family can provide a crucial role to address these challenges. So this is where our study comes into. So we formalize this question into two main research questions. The first one asking whether households receiving transfers have a likelihood to be homeowners, which is higher compared to those households not receiving transfers. And then conditioning, so those households who receive a transfer, we ask whether they are able to afford properties of a higher value. And so the policy implications, so our research can be of interest for policymakers if they want to keep contributing to support housing affordability for younger households and in general home ownership in the country of Malta. Okay, so our research falls into an already quite established set of literature, which I'm not going to explain in detail, but this really formed the basis for our analysis. It has been existing since already 20 years and investigate the various mechanisms between the relationship between transfers and home ownership. Okay, so before jumping into the core of the analysis, a preview of the results that we obtained is that a large share of Maltese households receive transfers very close to the time of home acquisition, and if we filter on young households, this is even more the case. And then the results of the econometric section is that indeed we find evidence that those households who receive transfers have a higher likelihood to be homeowners. Likelihood in the form of odds ratio, that's the measure that we use. So quantitatively, those households have 4.4 times higher odds to be homeowners. And again, if we restrict to large transfers, the effect becomes even higher. And this is what regards to the first research question. Regarding the second, we also find evidence that transfers are indeed associated with the possibility to own properties of higher price. And quantitatively, those households receiving a transfer are so they possess properties which are 44.9% more expensive. And we also find a relationship with an increase in the transfer value also corresponds with an increase in the HMR value. Okay, so let's start with the analysis. So the dataset that we use is the Household Finance and Consumption Survey for the country of Malta. So in general, the FHCS is a whole euro area database, so it contains information on euro area countries as well as some others, such as Switzerland, Norway. And it contains microdata on households, so containing information on their assets, liabilities, wealth, and general also socio-demographic characteristics. So it is conducted every 3-4 years, and we use all the 4 waves, so up to the earliest one of 2010. Most of our variables are, of course, derived from the section which is called Intergenerational Transfers and Gifts section, which give us information on whether a household has ever received a transfer in their life, if yes, when they received it, the value of such a transfer, whether it was in the form of money, already real estate, financial assets, or any other possibility. And also, we regard as a transfer, in our baseline specification, we regard as a transfer irrelevantly whether it is a gift or an inheritance. So this is our gross definition of transfer. Okay, so in this first piece of evidence, which is called stylized fact or descriptive evidence, we show a tabulation of, so we show the share of those households who have ever received a transfer in their life. And this share in Malta, as I anticipated, is approximately 1/3. But then, if we disaggregate, so first disaggregation is that between homeowners and what we call others, but mostly contain renters, we find that homeowners are much more likely to be recipient of transfers compared to renters, more than twice as much. Then, the second piece of evidence regards the quantity, so the size of transfers. And we just saw that homeowners are more likely to receive a transfer. And here we also see that homeowners on average receive transfers of a higher size. This is true throughout all the distribution of transfer sizes, so the various quartiles and other deciles of interest. But this piece of evidence also tells us something else. It tells us that, at least in Maltese data, we had to perform a quite interesting data cleaning because P10, which corresponds to the first decile, tells us that 10% of households in our sample received a transfer which is equal or inferior to 3,000 euros. And all these values are adjusted for inflation, so adjusted reported in 2020 values. And a key assumption that I will formalize later is that a transfer, so starting from our gross definition of transfer, a transfer, in order to be of interest for the decision to become to become a homeowner, needs to be sufficiently large. So intuitively, we can think that a transfer of 3,000 euros is unlikely to have a significant effect in this sense. But I will formalize this argument later. So the third Stylites fact instead answer to the question when, so when transfers were received compared to the time of home acquisition. And indeed, this is what this histogram shows. So it plots the difference between the year of inheritance and the year when the household became a homeowner. And this big column non-zero shows indeed that a large share of households receive a transfer the same year, so the difference is zero, the same year when they became homeowners. And in the left panel, this is computed for all households, so we see that 30% of all households, of those who receive a transfer, 30% of them received it the same year when they became homeowners. And if on the right panel we filter on young households, we see that this is even more the case. So conditioning on those young households who receive a transfer, 50%, so half of them received a transfer the same year when they became homeowners. And these descriptive evidence are quite powerful and could represent already an evidence on their own, a result on their own. But again, similarly to a restriction which we imposed before, also this descriptive evidence tells us something else. So it tells us that there is a large quantity of transfers which happen very far away compared to the time of home acquisition. So to the left of the columns, we have transfers received before the year of home acquisition, and to the right, accordingly after. So again, I will formalize this argument. This is a further restriction we perform on transfer, but the transfer has to be sufficiently close to the time of home acquisition in order to be relevant. We don't expect a transfer to be received 20 years before to have an impact on the decision of homeownership. Okay, so the last piece of evidence coming from the descriptive statistics section is the time when households become homeowners. So the age when households become homeowners in the country of Malta. And this is quite early compared to many other countries. So these are the quartiles, and P75 corresponds to the third quartile, saying that 75% of the observations become homeowners in Malta before the time they turn 40 years old. So the third quartile is 37 years old. It is quite early. So this speaks to the fact that homeownership in Malta is a phenomenon that happens early. Okay, so summarizing what we collected so far from the descriptive evidence. So we found that around 1 out of every 3 Maltese households have ever received a transfer in their life, and this share together with the amount is higher for homeowners compared to renters. And then a large share of those transfers happen very close to the time of home acquisition. Again, even more so for young households. And so this led us to formulate a hypothesis that there may be some sort of link between transfers and homeownership in Malta. And now formalizing the restrictions, which I just cited before, so coming from our gross definition of transfers, we pin down precisely what are the transfer of interest that may have an effect on the decision to become a homeowner. And the transfer has to be sufficiently large, so that's the restriction number 1, and as a threshold we choose 32,000 euros, which corresponds to the median of the transfer distribution. A disclaimer, this restriction, like all the other two, are then challenged in the robustness check section, showing that indeed our results do not depend on a particular threshold that we chose. But we will also see evidence that this threshold of 32,000 is confirmed by the data. So a second restriction is also regards time. So as I said, a transfer has to be close to the time of home acquisition to be considered relevant for it. So up to 5 years before to 3 years after the time of home acquisition. And why after? Because how the variable is recorded in the FHCS, it also, so the year when you become homeowner could also represent the year when you become owner of the land where you then are going to build a house, or maybe a less extreme case is also the case when you became owner of a house that requires serious renovations. So this is why also transfers received immediately after can be of interest for the decision of home acquisition. And lastly, the third restriction speaks to the last piece of evidence, is that for a subset of our models, we restrict our attention to younger households. And who are young? So young are those up to 40 years old. But again, as I said, we will challenge all those restrictions later on. Okay, so corresponding to our research questions, so to research questions, we have 2 classes of models. And the first one investigates the relationship between transfers, so whether transfers are associated with a higher probability to be homeowners. And given that we're talking about probabilities, likelihood, we of course use a linear probability model, in this case a logit model, where the dependent variable, so homeownership, is a dummy, so equal to 1 when the household is owner of a house, so regardless of mortgage owner or outright owner. And the main regressor of interest, transfer, can either be a dummy itself in the baseline distribution, so showing if being equal to 1 if our definition of transfer of interest applies. So as I said, a sufficiently large transfer, sufficiently close to the time of home acquisition. But then we play with alternative specifications, so another definition of transfer can be a disaggregation of this dummy into a series of bins corresponding to transfers of different size. Okay, then we also control for a series of characteristics, so demographic ones, the education level of the households, the employment status, the household size, as well as some economic ones. And importantly, I highlighted, so for this set of models, so the first class of models, we restrict our sample to only young households, because the evidence shows that in Malta, home ownership, home acquisition is a phenomenon which happens early. And these are the results. So, what I highlighted is the first model. And as I said, it is a dummy-to-dummy model. And the interpretation of the coefficient starts from the fact that these are odds ratios. So 4.4 means that those households receiving a transfer of interest, as we defined, have 4.4 times higher odds to be homeowners compared to their peers, so young households who don't receive any transfer. And this is significant at the 1% level. Then, in our second specification, as I said, we disaggregate this dummy into 4 dummies corresponding to transfers of different size, and in particular, the thresholds are based on the quartiles of the transfer distribution. And as I mentioned before, the evidence supports the fact that 32,000 is the right threshold after which transfers become important for the decision of homeownership, because transfers start being significant after this threshold. And we also see, as we can expect, that the effect becomes stronger. So for the largest quartile, so transfers larger than 94,000 euros, we have that the odds of homeownership increases by 5.5 times. So they are 5.5 times more likely to be homeowners. And this is a quite powerful result. Okay, so we also control for a series of characteristics. We, of course, don't show all of them, but as we can expect, being married is correlated positively to the probability of being homeowners, and also the belonging to the highest income quintiles. Okay, so these were the results for the first class of models, and now we jump to the second, which corresponds to our second research question, which investigates the relationship between transfers and the possibility to own a property of a higher value. So it looks very similar, and indeed it is, but importantly, the dependent variable this time is a continuous variable. So this is not anymore a logit model, it's a standard OLS, because the dependent variable is the log of the house value at time of acquisition. And again, the rest is very, very similar. So transfers, our main regressor of interest, in the first specification is a dummy. So we would have a dummy to log model capturing what is the increase in the log house price as a result of receiving a transfer. Or in a second specification, it will be a log to log model capturing the impact of an increase in the transfer size on the HMR value. But it will be clearer later that I show the table. And importantly, here I highlighted that we relax the third assumption. So these models are estimated for all households. So so households older than 40 years old are included. Why? Because we assume that while homeownership happens quite early, still we allow for the possibility. So a person which already possesses a house receive an inheritance, and we allow for the possibility for him or her to shift to a property of a higher value. And this is it, the result of this second class of models. So the first column we have, so how it reads the coefficients. So the impact of the dummy, so receiving a transfer leads to an increase in the property value of, on average, 44.9%. While the second column, as I said, it is a log-to-log model, so a 1% increase in the transfer size corresponds to a 1.6% increase in the HMR value. and both results are highly significant. So you can see here that the sample size is larger because, as I said, we included also adult households. Again, we control for a series of characteristics, positively correlated with higher education, allows to possess properties of a higher price, self-employed, and positively related with the income, growing in income. Okay, so I guess I have time also to talk about the robustness checks. Since, as I said, we challenge those assumptions to see that they do not depend. Perhaps the first one is the restriction on transfer size. 32,000, some people may consider that as quite high, and indeed we decreased that threshold from 32,000 to 10,000 euros, which this time corresponds to the first quartile, and we see that the results are slightly decreased but remain robust in terms of significance. Then the second one, the second restriction regards time. So we do not relax, but the opposite, we restrict it to from 3 years before the year of home acquisition up to the same year of home acquisition. Again, finding that it is slightly reduced, but robust. And again, for age, so for the first class of models, we re-estimate it, including households older than 40 years old, finding that the results are robust. Lastly, a quite interesting one. So while the first three can be called as sanity checks, the fourth one is quite interesting and tries to address a potential source of endogeneity in our research, dealing with voluntary gifts. So if the household anticipates voluntary gifts, then these may be also correlated with his or her decision of home ownership. So this may cause some potential reverse causality in our research. And so finally, our fourth and last robustness check is a re-estimation of our models, excluding all voluntary gifts. So leaving only inheritance, which it is a quite realistic assumption that they are not expected. Okay, so we are about to conclude, and the paper is still is in its final phases. So we are about to get the final reviews, but possible extensions of the paper may investigate the following points. So the mortgage channel, which is an aspect so we investigated the relationship between transfers and home ownership at a more gross rate, while future research could investigate deeper what are the various mechanisms behind it. And also another aspect is that of the panel component, which unfortunately we were not able to exploit because of a small size and because of little variation in the data. So we saw that households who were interviewed in the wave before and the wave after, they were homeowners in both of them. So we unfortunately were not able to exploit it. And both points could be addressed possibly by increasing the sample size. How? Exploiting the fact that the FHCS is a quite standardized dataset, and so we could expand the study to other European countries quite easily. Okay, so this was it, and wrapping up. So what we obtained with our research, we find indeed evidence that transfers actually do play a role in the decision of home acquisition, especially so for younger households. Quantitatively, younger households receiving a transfer have 4.4 times higher odds to be homeowners compared to their peers of the same age who don't receive any transfer. Then again, larger transfer result in a stronger effect, with the odds jumping to 5.5. And again, transfers are strongly related with properties of a higher value. How much? On average, 44.9% more expensive, with again a more than one-to-one relationship. So transfers increasing of 1% corresponds to an HMR which is increasing in 1.6%. All these results are confirmed to be independent of any of our assumption, thanks to what the robustness checks proved. So this was it, and thank you for your attention. I'm open to any question and suggestion. Thank you.
So we open the floor for questions.
Sure.
So if I understand correctly, there was no way for you to know what was the value of the property which was bought once receiving a transfer, correct?
No. We actually we have the information in the FHCS, and it's actually the dependent variable in our second class of model is the value of the property at time of acquisition.
Okay. So you possibly couldn't take into account the size of the transfer to see if that, for example, corresponded to the typical deposit, the 10% deposit that they have to make in order to purchase the property.
The down payment. This is indeed something that so I mentioned in the possible extensions. So future work through higher availability of data, which of course in Maltese FHCS is something that we suffer particularly if we disaggregate too much. Then we can obtain a result, but then we may ask ourselves how representative is this if the number of observation is too low. But absolutely, this is a possible extensions may investigate that channel.
Thank you. Very good paper.
There are no other questions. I think
Okay.
we can end the session. Thank you very much, Valerio, for your interesting
Welcome.
work.
Thank you for your attention.
I now invite Dr. Drack for his concluding remarks that will effectively conclude this event for us today.
Dear guests, I had a long speech to give to you, but since we're late, I'm going to cut half of it off. We are now at the close of our research year, and as you have seen, it's been quite fruitful thanks to the dedication of the research staff here at the bank. As we transition to the new year, we are planning and setting the priorities for future research work. The letter will leverage on the work, some of the work that you have seen, but it will also have to reflect emerging policy questions and methodologies that we believe will shape central bank research across the euro area. In particular, the ongoing monetary policy strategy review at the ECB will bear an influence on the bank's research agenda greatly next year. The bank is participating in 2 work streams of the strategy review. For the foremost one is the study of the inflation environment. This focuses mainly on aspects relating to improvements in the analytical toolkit required to forecast and produce valid scenario analysis at national central banks. Moreover, the bank will also be contributing to a work stream that focuses explicitly on monetary policy formulation and communication to third parties. Given also the renewed emphasis in the monetary policy strategy review on model toolkit developments, the department will be further developing the bank's model suite. In particular, we will continue working on our semi-structural model stream. We will extend again the estimation period of the behavioral equations of the model so that we try to look at the post-pandemic period, which will be quite challenging as there was quite a structural break there, as well as the recent benchmark revision to national accounts, which in the case of Malta has been quite large compared to the rest of the euro area. Stream will also undergo important refinements on the supply side. And we hope that this should help us develop a better understanding of the role supply-side shocks, such as cost-push shocks, as well as migration developments, play in shaping the dynamics of Maltese macroeconomic variables. On the structural front, we will be seeking to expand the user base of our DSG models here at the bank through in-house specialized courses as part of a wider initiative to expand the skill set of economists working across the bank. Against the backdrop of fast-moving political and economic landscapes, the complexity of the policy questions to be answered by economists and the importance of timeliness in policy formulation and implementation have increased substantially. Up until recently, the bank, in line with other policy institutions, relied mainly on official data for both research and policy formulation. Nonetheless, the speed at which economic policy is required to respond to new shocks has prompted the bank to invest more heavily in the use of non-conventional big data to track economic conditions in real time. For instance, next year we will be looking to update the methodology behind the bank's estimates of real-time business conditions in Malta,
This project will seek to utilize state-of-the-art estimation procedures, not only to improve the reliability of our business cycle tracker, but also to expand the depth of the analysis that can be undertaken with it. In a separate project, we are harvesting daily food prices from public sources, mainly the internet, in a bid to construct a real-time food inflation tracker. Using big data and machine learning techniques, we hope to produce an outcast of food inflation which would be able to inform policymakers in timelier manner of current inflation dynamics, as well as aid the bank's forecasters in their efforts to project monthly HICP inflation. As we come to the end of this research workshop, I would like to thank all presenters and their co-authors for their work, as well as all of you for your insightful contributions. I would also wish to extend my gratitude to the events team of the bank for another impeccably organized conference. Thanks again for your participation, and I look forward to welcome you again at next year's annual research workshop. Thank you.
Second, so just I want to thank Carlo for joining us, the governors, all of you. I think that was a great day. I think it was a success. It was very interesting. There were many discussions, so thank you very much. And also I want to thank all the team. I would like to thank Moira and Debbie for the bulletin, Rose, Julie, Roxanne, and Tony with the organization of the event, and Chantel for the creation of visuals and marketing material. And now we can go in the adjacent room to have a couple of drinks, networking, and see you next year. Thank you.